Good morning, ladies and gentlemen. A very warm welcome to you back on Business Studio Television. This is in our ongoing series of trying to track sensible corporate earnings across the spectrum of quarterly results that have come in to try and find out stocks that might give stellar returns over the next 6 to 8 months or 1 year or maybe in the medium term. The logic being capacity expansion is over. There is fresh capacity coming on stream, and lower expenses plus higher sales and profit will ultimately impact the stock price positively. Joining us on the show is Mr. Adish Patil, Chief Operating Officer and Chief Finance Officer at Aarti Drugs, where a strong quarterly number was observed. Sales rose 9% to 653 crores. Net profit was up 29% to 45 crore rupees year on year. And the company completed two major capacity expansions, one in Gujarat at the cost of 220 crore rupees, 60 metric tons per day. This was a backward integration. Aarti Drugs, of course, makes API, specialty chemicals, and pharma intermediates. Let's welcome Mr. Patil. Good morning, Adishji, and a very warm welcome to you, sir. How would you see this capacity expansion over the next 1 or 2 years or so? Aarti Drugs has been in the sideways mode for the last 3 years. How much of this capacity is on stream now?
Yeah, thank you for having me. So both these greenfield projects, one is at Tarapur, which is salicylic acid. That greenfield project we started last year itself. We faced a little bit more troubleshooting time in that particular product, but right now the quality is very well accepted in the market. We have been supplying to majority of the customers, so the product is approved. Now it is just a matter of scaling up the plant. So this quarter we'll be scaling up to roughly around 300 tons per month kind of a thing, and next quarter we'll try to aim for 500, and then step by step we'll go up. As far as the Saika Greenfield project is concerned, which we just commenced in September month, that is a backward integration as you rightly pointed out. So there the initial production has commenced really well. All the targeted norms are reached, the quality parameters are met. So we hope that that should start adding to our bottom line very soon. Within in 2-3 months, the plant should stabilize, and then it will start reflecting in our P&L as well.
Okay. Mr. Patil, let's begin with the basics. Now that this 537 crore rupee expansion is out of the way, sales, how should they compound over the next 2 or 3 years or so? The reason why I ask you this is, if you look at the past 5 years, sales have compounded just at 6%. I'm sure a lot of shareholders are not really very happy with this kind of a progress. How does the future look to you over the next 2 years or so?
Yeah. So first, to talk about the past performance, even though the sales top line value seems less, but actually the volume growth will be higher, because the selling price of the APIs have come down quite steeply in last 2-3 years. So in spite of that, we were able to maintain our volume turnover, and it did reflect in the bottom line to some extent. Obviously, going forward, since last 9 months or so, the selling prices are quite stabilized. So now the true margins of the business are coming out. Having said that, I would like to point out that salicylic acid, where we have been bearing some troubleshooting losses, is also being expensed out in the P&L for last 6 quarters. So whatever numbers you are seeing in the P&L at this point are including those losses. So even when we break even in those projects, the margins should ideally improve further.
Okay, fair point. You are into 3 businesses, as we've discussed earlier. APIs, specialty chemicals, and of course formulations and pharma intermediates. At this point of time, where is the maximum growth coming in within these 3 segments? How about formulations? I did see your numbers. There was a 25% year-on-year growth on formulations. Is this something that is maintainable?
Yeah. So the long run target for our formulation segment, which is roughly around 300 crores per annum as of now, uh, we expect it to grow, to a level of around 800 to 1000 crores in coming 5 years. That's a long term target for us, to reach a turnover of at least 1000 crores for formulation business. And the main areas of growth for formulations are, there are so many dossiers which we have registered in a lot of markets already. So those dossiers are being commercialized as of now, and the big oncology block, that would be a big growth driver for us. Roughly, the full scale potential from that block would be around, anywhere between 400 to 600 crores per annum, depending upon the utilization and the product mix. So that would be a big growth driver for formulation segment. So as far as API and spec chem is concerned, so API segment, we already have, capacities which can take the standalone company's revenues. When I say standalone, it is excluding formulation, but including API and spec chem both. So our current capacities itself, can
Yes.
can take us to a revenue of around 2800 to 3000 crores, and plus we just added this to greenfield projects, salicylic acid, which can be termed as, intermediate also, because it goes in both in API manufacturing as well as in manufacturing of salicylates, which are ultimately used in cosmetic industry. Whereas the methylamine plants, that will be
Yes.
termed as
Uh,
second segment.
Okay. Now, before this, these two greenfield projects came online, one in Tarapur and the other in Gujarat. What was the level of capacity utilization at Aarti Drugs? Where do you think it is headed at the same time next year, which is, let's just say, end of October 2026?
Okay, after 12 years, after 12 months, sorry, right? So, uh, if I
Yes.
accept the greenfield projects, the capacity utilization would be somewhere between mid 70s, roughly 74, 76%. If we add the both greenfield projects, then the salicylic acid plant, uh, uh, you know, right now, I would say our potential would be roughly around 100 to 150 crores. We are trying to scale it up to, 250 crores of total potential, as by expanding the capacity further. And as far as Saika is concerned, because we'll be captively using that product, it won't add to the top line that much, but still we expect, around 150 crores of sales from that site as well. But majorly, means other than that, around similar quantity will go in the captive consumption, and that should ideally reflect in our bottom line.
Okay, exactly. That's my next question. Now, when you look at sequential quarters from now on, both sales and margin expansion should happen. Would you want to put a number on where sales as a percentage could grow over the next 1 or 2 years, and how much would EBITDA margin expand? Two reasons: you have gone through with capex, and of course there are no expenses in the pipeline on capacity over the next 12 months or so.
Right. Um, so I will go a bit, means I will add one more year. I will say, let us have a target for, let's say, 3 years from now. So what we see is that we do have a visibility of reaching a sales value of roughly around, anywhere between 3200 to 3500 crores. That should be our target top line for the next 3 years, 2 to 3 years, I would say. So it all depends how quickly the utilization ramps up. If it ramps up earlier, then we can reach that target a bit earlier, or else 3 years is the target, conservative target for us to reach that top line. And as far as EBITDA margins are concerned, what we estimate, uh, if the market continues as it is, what it is right now, with the addition of these capacities and with, uh, you know, uh, new process. We are doing a lot of R&D in process improvements as well, and we have been getting success in that. Plus, we are doing a lot of improvements in energy consumption. So all that put together should help us take our EBITDA margins to at least between 15 to 16%. And when the oncology block comes in full swing, that will be more long term, like 4 to 5 years. Then probably that should pull up our EBITDA margins further up by a couple of.
Okay, fair point. That's a fairly good estimate that you have. Now, let's look at the raw material side. What have been, price trends for sourcing raw materials? Do you think the volatility is easing? Uh, is there scope of sourcing raw material cheaper so that margins might expand? What's the situation on that side of the equation?
Okay. Um I would like to point out that roughly 50% of our raw material consumption is imported, and rest is we are buying from India. And out of that 50 means the import, around 80% of that import content is from China. Now, if we see out of total raw materials what we consume, around 15 to 18, 1 5, that is 15 to 18% of the raw material is only coming from China. Otherwise, though we are procuring some of the raw material from China, but there are Indian sources as well available in India. So if anything goes wrong, we have alternate suppliers as well at marginal increase in cost. As far as reducing the cost further down, as of now, we feel the prices of raw materials are almost bottomed out. We don't see further reduction in the raw material prices. Whatever raw material pricing level is there as of now, we think that is fair enough for us, to expand our margins going forward.
Okay, okay. Let's focus on the geographical expansion of business. How much from exports and how much from domestics? This US trade deal, its absence and higher sanctions, how has Aarti Drugs navigated this process over the last 6 months or so? How do you look at this space now, especially exports?
So there are two parts to it. So fortunately, we just got USFDA approvals for both our API plant as well as our formulation plant. Formulation is the oncology segment, last year itself. Um as far as the API segment is concerned, the APIs are typically exported either to Indian geography, not, I won't say exported, means either sold to Indian geographies or to European geographies, because all the USFDA formulation manufacturers are as of now, stationed in these geographies. So when we sell through them, automatically the tariff doesn't apply to our API segment. So that is one part of it. Secondly, as far as the oncology is concerned, it's a long-term game. We are talking about third, fourth, and fifth year from now. So definitely higher tariffs to some extent will impact our business, because because Trump administration might want their oncology to be manufactured in the US market. But then the trade deal is going on. So as of now, in for next 3 years, we don't see any impact for us. But if it stays this way, and if the tariff stays very high for like more than 3, 4, 5 years, then it might impact some of our growth plans as far as oncology department is concerned.
Okay, fair point. Mr. Patel, this is just a stand back question. Aarti Drugs hasn't had great 3 years. Sales have been more or less flat. Stock hasn't gone anywhere. Profit growth has been mediocre. How do you feel about the next 1 year, 2 year or so, given that the capacity expansion is behind you? Are you sleeping easy these days?
Yeah. So definitely the things can be much better even from what we are doing right now, because there are a lot of positive factors which we can see right in front of us. So one is the breaking even of salicylic acid. The second one is the ramp up of utilization of the Saika plant. we have means 50% is our own captive consumption. Then what 50% we have to sell outside. Even out of that, I would say 25% is taken care of by the group company's consumption. So demand is not a problem for that plant. So both these greenfield projects playing out for us, and then because the pricing is very much stabilized, the true margins from our API business will come back to us. In addition to that, in API segment, we just got to, I will like to highlight that our US FDA plant, API plant was under import alert for almost 10 years, and now we got out of it. So it has opened up not only the US, but also the European geographies for us. Lot of approvals are coming in for that plant from the customers for Europe market, as well as the US market is going on, but Europe market is coming quicker. Uh, so from overall perspective, there are a lot of positive growth drivers, both for revenues and for margins going forward. So definitely what we feel that the next 2 years will be much better than the past 2 years what we had.
On that very hopeful note, Mr. Patil, thank you so much for your time. And let's hope that this fresh capacity expansion, which is now on stream at Gujarat as well as Tarapur, adds to not only top line, but also to operating margins and of course to the bottom line. Very kind of you to come in and discuss the next 2 years of Aarti Drugs with our viewers. Here's wishing you all the best, and hoping that sales and profit will compound more strongly in the next 2 years or so. Have a nice day, sir.
Thank you. You too. Bye.
Yes. That, ladies and gentlemen, was Mr. Adish Patil, CFO and COO at Aarti Drugs Limited. News continues on Business Today Television. The markets are in good shape. Please continue watching BTTV.